Hey everyone, Donnie Schultz, Embrace Home Loans here with our market update. So it is Friday, January 20th, 2023. Starting off the year pretty strong. Rates under a little bit of pressure today, but for the most part, we have seen a decent pullback off of the highs that we experienced back in October. Rates probably topping out, 30-year fixed rate probably topping out a little bit above 7% right now. Average 30-year fixed rate in the 5.875 to 6.25% range, depending on the lender you're looking at. We are expecting, rates to further improve moving throughout 2023. The big question mark will be, what does the time frame look like for that to happen? My estimates are third, fourth quarter. We'll probably see more significant drops. I think everything that the Federal Reserve is doing to fight inflation so far has been working. Some question marks around what kind of damage, economic damage, has been done because of that fight, but inflation numbers are coming down. We've had three consecutive reports showing inflation dropping. We've seen consumer spending decrease. We have seen manufacturing costs go down. That has resulted in a decrease in cost of goods and services, with the exception of eggs right now, right? We have the egg shortage, but for the most part, costs have gone down. That's translating to inflation. Home sales are down. Certain areas are seeing declines in home values. Long Island holding pretty steady here, because what we're also seeing is a significant number of homeowners who have their financing in very low interest rates hesitant to list. So we still have an inventory issue. We have high demand from buyers. Right now, great time for buyers to be stepping into the market, because once news hits that rates are moving lower, and there's going to be a point that they hit where we probably see a flood of buyers back into the market. And concern there is, what does that do to values and prices? Do we get back into significant bidding war situations when rates hit a certain level? And what is that level that causes that? That is also a concern of the Fed. So the Fed is going to try to tamper any kind of significant pushes lower in interest rates, also pushes higher in markets, so the stock market. What they don't want to see happen is rates drop significantly in a short period of time, and then consumer spending ramp back up, price pressure increase, and now we are in the same boat with inflation that we were in 12 months ago. So what I have up on my screen right now is the 10-year Treasury chart. This is probably the easiest way to correlate what's happening with mortgage rates on a day-to-day basis. As the 10-year Treasury increases, mortgage rates typically increase. As the 10-year Treasury decreases, mortgage rates will decrease. So you can see this is a 12-month outlook. This is, for the most part, what we experienced in increases over 2022, the peak right here in October, and now we've had this pullback, and again, we expect that to continue, and something that we'll keep an eye on, and something that we'll update you with. The big thing that is occurring right now, and if you read the email before you watched the video, we had a major announcement yesterday from the FHFA. The FHFA controls the two conventional loan securitizers, Fannie Mae and Freddie Mac. So back out of the financial crisis, they were private companies. They were bailed out by the government. Now they are, for all essences, government-controlled entities. So the Federal Housing Finance Agency released new LLPA structures. An LLPA is a loan level price adjuster. It is a cost passed on from Fannie Mae and Freddie Mac to the bank and to the consumer, typically based off of risk characteristics. So if you were putting down 3% down payment and you had a 660 FICO score last week, your loan level price adjusters would be significantly higher than if you were putting down 20% with a 740, 780, 800 FICO score, right? The risk characteristics and the assessment says that the borrower putting down more money with the better credit history is more likely to pay their loan and not default over the course of that loan. The FHFA has been making more and more of a push to get into affordable housing and better serve low to moderate income borrowers, which is very, very important. However, the way that they are doing it is by subsidizing qualified borrowers. They're taking, they're having right now, and with this announcement, they're having more qualified buyers foot the bill to promote affordable housing. And I have some major concerns on this because, Fannie Mae and Freddie Mac have considerably tightened up their risk assessment on these files. So when a lender gets a loan in, we run it through an automated underwriting system. Some of you may be familiar with Desktop Underwrite, Loan Prospector, DULP, right? Lenders will run those files through, and we need to get an approval. We need to have an approved finding. And, over the last 2 years, we've seen that really tighten up. So it's not uncommon for us to have a single borrower maybe putting down 20%, 25% with a 750 FICO score, and one or both of those systems not approve the file. They don't like the risk assessment of the single borrower, or they don't like the number of trade lines, or this or that. So when we look at these LLPAs and we say, okay, lower down payment, lower credit score borrowers are benefiting from this. It does help them, but most likely they're not going to qualify for these loans. Where our average, top tier borrower, 10%, 15% down payment, 740 and above credit score, now they're being penalized. They're paying higher costs, and higher cost translates to higher interest rates. With where rates are, there's not a lot of room in the rates to absorb that cost. So, if a borrower has a 740 FICO score and they're putting down 15%, their rate is going up probably about 0.375% once this goes into effect. So this is for loans that are delivered after May 1st. You'll probably start seeing it hit lenders' rate sheets in the next couple of weeks because we have 90-day contracts here. So, it's very tough to say past early February that we're going to be able to deliver a loan before these adjustments start hitting. You're going to start seeing this carry over to rate sheets. So even though we've seen rates come down for the majority of our conventional borrowers in this market, this is going to have a negative impact for them. Now, I will say that this is going to create an environment in the lending world where it is more important than ever to have an experienced, attention to detail loan officer working with your buyers, because the way that the loan is structured, the way that the loan is presented is now going to have a significant impact on rate and cost to a consumer. So there are going to be different ways to structure this. I do highly recommend, making noise about this. I think this does have a big impact on the market. I think it is a disservice to home buyers. I think here in particular, our average first-time home buyer is significantly impacted by this. I think that affordable housing is extremely important. I think low to moderate income lending is extremely important. I think the focus should be on the traditional program that has served that that box of consumers, which is the FHA program, Federal Housing Administration. Now, over the years, the Federal Housing Administration, in my opinion, has become very expensive. The upfront mortgage insurance premium, 1.75%. That's a big cost. Monthly mortgage insurance, 0.85%. That's a significant cost. The mortgage insurance being on for the life of the loan. Those things should be evaluated. Those things should be lowered. The Federal Housing Administration's mortgage insurance fund has performed extremely well over the years. I'm surprised there haven't been changes to the mortgage insurance terms and the cost of the borrowers to this point. And I'm surprised that the affordable housing push is coming from the conventional securitizers versus the Federal Housing Administration. So I think it's important for us all to make our voices heard with our representatives. So, your congressmen, your congresswomen, your senators, NAR, the NBA, LIBOR, right? Get out there and say, hey, we're aware of this. We know it's affecting our consumers. It definitely has the potential to impact the market here. So a little longer of an update. I do think this is really important. I think it's flying under the radar. There's not a lot of news about this. It was kind of snuck out there, and I don't think, many professionals in our industry realize what kind of impact this is going to have. So definitely something to look into. You don't have to take my thoughts. You could definitely form your own. I mean, this could make FHA financing more attractive to borrowers. It just doesn't sit well with me where qualified buyers are being penalized. Especially when those qualified buyers tend to be our average first-time home buyer who are, with this current rate environment, are budgeting and living paycheck to paycheck, trying to invest and trying to get into home ownership. It's not an easy market that we're in. Prices are high, property taxes are high. The FHFA did come out with some nice incentives for first-time home buyers who are at or below 120% of the area median income for qualifying, where these LLP, these loan level price adjusters are completely eliminated. But that calculation is $135,000 for Long Island. We don't have a lot of borrowers with where the current rates are that are below that and can qualify. Do we run into that situation? Absolutely, but it is a little bit less far and few between than we'd like. As rates come down, it might become more prevalent, but it really depends on what values do, right? What home prices do. So something to look at, something to keep in mind. Appreciate your time today. Talk to you guys soon.